Exemption of income from foreign permanent establishments to eliminate double taxation. To prevent or mitigate the risk of international double taxation, a resident person, i.e., a business or entity that is a tax resident in the UAE, has the option to make an election that exempts income derived from its foreign permanent establishments, FPEs, from being subject to corporate tax in the UAE. This election is designed to align with international tax principles and to ensure that businesses operating in multiple jurisdictions are not taxed twice on the same income, thereby fostering a more competitive and efficient tax environment. The primary purpose of this election is to allow resident persons to exclude specific foreign-sourced income from their UAE taxable income. When this election is made, it has significant implications for how income, expenditure, and losses related to foreign operations are handled for tax purposes. By making this election, businesses with foreign permanent establishments, which are essentially branches or fixed places of business in foreign countries, can streamline their tax reporting and potentially reduce their overall tax liability. 1. The election process and its impact on taxable income. When a resident person chooses to make this election, it must exclude certain types of income and related expenditure from its calculation of taxable income under UAE corporate tax law. The key exclusions include: A. Income from foreign permanent establishments. Income derived from foreign permanent establishments will not need to be included in the resident person's taxable income in the UAE. This includes any profits or earnings generated by the foreign operations that would normally be subject to UAE corporate tax. The rationale behind this exclusion is to avoid taxing the same income in the UAE that has already been subjected to tax in the foreign jurisdiction where the foreign permanent establishment is located. B. Associated expenditure. Any expenditure directly associated with generating income in a foreign permanent establishment will also be excluded from the calculation of taxable income. This includes expenses such as operational costs, overhead, and costs of providing services that are specifically tied to the activities of the foreign branch. C. Losses from foreign permanent establishments. If a foreign permanent establishment incurs losses, these losses will also be excluded from the resident person's taxable income. This means that the resident person will not be allowed to offset these foreign losses against other income for UAE tax purposes, preserving the integrity of the tax regime by keeping foreign losses separate. 2. The role of foreign tax credits. The election to exempt income derived from foreign permanent establishments comes with an important trade-off. By opting for the exemption, the resident person will forfeit any potential foreign tax credit that might have been available if the election had not been made. A foreign tax credit typically allows a business to reduce its UAE tax liability by the amount of tax paid on the same income in a foreign country, to avoid double taxation. However, once the election is made to exclude income from foreign permanent establishments, the resident person cannot claim a foreign tax credit for taxes paid in the foreign jurisdiction, even if the income was taxed there. This ensures that the exemption aligns with the subject to tax requirement, explained below, and prevents the risk of double relief. 3. Treating the resident person and foreign permanent establishments as separate businesses. In determining the income, expenditure, and losses related to foreign permanent establishments, the resident person and its foreign permanent establishments must be treated as separate and independent businesses. This means that any transactions between the resident person and its foreign permanent establishments must be conducted at market value. The principle of market value ensures that intragroup transactions, such as the transfer of goods, services, or intellectual property between the UAE-based parent company and its foreign branches, are priced in a way that reflects what independent entities would charge each other in a similar transaction. This helps prevent tax avoidance strategies where transactions are artificially structured to shift profits to jurisdictions with lower tax rates. 4. Subject to tax requirement. For the election to apply, the foreign permanent establishments must meet the subject to tax requirement. This means that the income derived from the foreign permanent establishments is only eligible for exemption if these establishments are subject to corporate tax, or a similar form of taxation, in the foreign jurisdiction where they operate, at a rate of at least 9%. A. Minimum tax rate condition. The foreign jurisdiction in which the foreign permanent establishment operates must impose a corporate tax rate of at least 9%, or an equivalent tax rate, on the income generated by the permanent establishment. This ensures that the foreign income is subject to a level of tax that justifies its exemption in the UAE, aligning with the UAE's goal of promoting fair international tax practices. B. The global application of the election. Once the election is made, it applies globally to all of the resident persons' foreign permanent establishments that meet the subject to tax requirement. This means that a resident person cannot selectively apply the exemption to specific foreign permanent establishments based on their tax treatment or activities. If a business has multiple foreign permanent establishments in different countries, the exemption will apply uniformly to all establishments that are subject to tax at the required minimum rate of 9%.